Okay, we are going to discuss about Quick Flow Limited as a manufacturing business. This paper is May-June 2015, paper 12, number 6. Quick Flow Limited is a manufacturing business. It provided the following information. At 1st of May 2014, you have inventory of raw material, work in progress, finished goods, factory equipment at cost, accumulated depreciations of factory equipment, and etc. until this part. Now, the thing is, remember, if it is 1st of May, 1st of every month, it will stand for balance BD. And this will stand for balance CD. Okay. Next, for the year ended 30 April 2015, during the year, these transactions happens. Revenue, purchases of raw material, factory wages, factory supervisor salary, office salaries, rent, and etc. But in manufacturing business, you have to differentiate between direct expense and indirect expense. Direct expense is direct material, direct labor, and direct expense. All three of them are prime cost. Direct material relates to raw material. Direct labor relates to the person who directly attached to the goods when the production happens. Now, in this case, factory wages will represent direct labor. After that, in manufacturing, you will need factory overheads. Factory overheads is indirect cost. So direct cost will create prime cost. Indirect cost is factory overhead. Prime cost plus factory overhead plus with work in progress, and then you will have a cost of production. Now, we have to find the direct material first, and then direct labor, and then direct expense. We already have direct labor, now we have to do direct material. But before that, this additional information is really important. First of all, you have information about depreciation. Factory equipment, rate of 10%, straight line basis. Factory equipment will goes for factory overheads. You have to differentiate between which one goes for manufacturing account or in the factory, or it happens in the office. You have to differentiate between them. In office equipment, that means it will occurs in income statement, while factory overhead is in manufacturing cost. Manufacturing account, I mean. Yeah. Next, a full year depreciation is provided in the year of acquisition, but none is provided in the year of disposal. Number 2, you have a new inventory equipment costing $5,000 was paid by check. This represents purchasing new. Purchasing new NCA. Old factory equipment with an original cost of $2,000 was sold at the same date at a profit of $6,000. This is represent disposal. The rent is to be apportioned 80% to the factory and 20% to the office. To the factory, that means it is for manufacturing account. To the office, that means it's for IS. And then, continue. You are required to prepare the ledger account for factory equipment at cost. Factory equipment is one of the NCA. NCA is non-current assets, okay? If we want to prepare this NCA account, transactions that will affecting this account is only 2. Okay? First of all, if it is purchasing new, or second of all, if it is disposing disposing old NCA. Okay, and this NCA will always be at cost. Okay, or sometimes it is stated at net book value, but normally it is for at cost. Now, since NCA is considered as assets increase in the debit side, first of all we need to do debit side. We have to check whether this factory equipment had a balance at the beginning of the year or not. We check on top. Yes, we have a factory equipment here at cost of 18,000 and accumulated depreciations of 7,000. Now, here we have a balance, so it is 2014, which is May 1st. You have a balance at the beginning for 18,000 at cost. Yeah, it has to be at cost because it is stated there in the questions. It has to be at cost. Now, if these questions give you information about purchasing new NCA, as I inform you in this part, NCA will be affected by these two transactions, purchasing new NCA or disposing old NCA. In the questions, we are provided with this information. Number 2, 30th of April 2015. Oops. Okay. 30th of April 2015, new factory equipment costing 5,000 was paid for by check. This is purchasing new NCA. And then old factory equipment with an original cost of 2,000 was sold. Okay, and this is the profit of disposal, 6,000. Now remember, if you want to prepare this T account, you cannot put other than this two: disposing old NCA and purchasing new NCA. In this case, profit of disposal is not in these two items. So, students' common mistake is to put this profit inside this T account. It's wrong. Okay, remember that. Only purchasing of new NCA and disposing of old NCA that will be posted in this T account. Okay, let's start. Purchasing new NCA. Purchasing new NCA will increasing factory equipment because it is an asset. So if you purchase new, it's added. And then it said here that you purchased that and paid by check, and the amount is 5,000, and the old equipment that has an original cost of 2,000 was sold. Okay, so how to answer that? The date would be 30th of April 2015, yeah? So 2015 April 30, we have a bank because you purchased new 5,000. And in the credit side, if you sold your equipment, that means your asset will be decreased. Asset decrease in the credit side, so you go to the credit side, dated 2015 April 30, and the details would be disposal. The cost of the disposed assets is 2,000. Okay, this is number 1 from here. This is number 2. Clear, yeah? Next, after that, you have to calculate balance CD. Balance CD will occur in the last date of the month. So, your balance CD would be 18 plus 5 is 23,000. So in the credit side, you also have to have a balance of 23,000. That means your balance CD is 21,000. It is from 23,000 minus 2,000, like that, yeah? Then it said that you have to bring down the balance on 1st of May 2015. So you go to the next accounting period, put the year 2015, May 1st, balance BD of 21,000. Then next, manufacturing account for the year ended 30 of April 2015. Okay, if you remember, in the manufacturing account, we will need this. This is your guideline. You have a direct material at the beginning, second, direct labor, third, direct expense, fourth, factory overhead, and fifth is work in progress. Now, the thing is, this direct expense, it might appear, it might not. Direct expense in this case, it can be a patent, royalties, license fees, brand name, etc. The thing is, this direct expense is not related to labor, it is not related to material, but somehow it is directly attached to the goods. So, in these questions, there's no direct expense, there's no patent, there's no royalties, license fees. That means you can ignore direct expense. But if there is, you have to put it under direct labor, so that you can total all of them and then to get prime costs. But in this case, we don't need direct expense because we don't have any. Okay, first of all, we start with direct material. To do direct material, it is the same like you are doing cost of sales. In direct material, you will start with opening inventory of raw material. After that, plus with purchases of raw material, and then minus with closing inventory of raw material. Opening inventory of raw material is given in the questions above. Remember about balance BD and balance CD. Balance BD represent inventory at the beginning of raw material, you have 5,000, and then at the end you have 4,400. And then purchases of raw material, this part is part of raw material. So 1, 2, 3. You put it in the manufacturing account. Remember, if you have a carriage in words of raw material and sale and purchases returns of raw material, you have to put it inside to net it these purchases. But if there's no, but because there are no carriage in words as well as purchases returns, so we can ignore them. Okay. Inventory of raw material at the beginning is 5,000 stated above, and then purchases is 48,000, and then your closing inventory is 4,400. So you have a 48,600. This is cost of direct material, or you can just put direct material, that's fine. Direct material. After direct material, remember the second one is direct labor. And in direct labor, in this direct labor, you have factory wages. Your factory wages is stated above this one. Factory wages is 20,500. So you put it there. 20,500. 20,500. And since there's no patent, there's no royalty, so you can add them now to have a prime cost. Your prime cost now is 100, 1, and 69,100. That's your prime cost. After prime cost, and then you do factory overheads and then work in progress at the end, so that you have cost of production. Now we are going to list our factory overheads. Factory overheads. In the factory overheads, first of all, we have, let's see in the questions above. Sorry if it is confusing for you, but bear with it. You have factory supervisor salary as your factory overheads. Office salary is not in the factory overheads, because it is for income statement. And then for rent, remember 80% goes for factory, 20% goes for IS. Selling and distribution cost is for IS, and loan interest also for IS. So we have 1 factory overhead, 2 factory overhead, and the third one is this one, factory overhead depreciation for factory equipment. Depreciations of factory machine. Okay, let's continue. Your factory overheads started with factory depreciation, (10% times with 10% times with the cost of the factory equipment, and your factory equipment cost is not 18,000. Remember, your 18,000 is at the 1st of May 2014. So where can you find this factory equipment is from question A. If you remember, you have $21,000 of factory equipment at the end of April 2015. So it's 10,000 times 21,000. So depreciation is 2,100. And then supervisor's salary. Supervisor's salary is copy paste 10,800. And then supervisor salary is done. The third one is rent. And then it said 80% of the rent goes for factory, and your rent is 18,000. So rent factory 80% times 18,000. So your rent factory is 14,400. Then that's it. You only have 3 factory overheads, so in total you will have 27,300. And then you add them. It is called as cost of goods manufactured. Total cost of goods manufactured is 96,400. Then after that, followed with work in progress. Work in progress at the beginning, and then work in progress at the end. At the beginning you have 2,000. 2,000 is from this side. Going back, there. Work in progress, beginning and closing. And remember, prime cost plus with factory overhead plus with work in progress net. Continue. Your work in progress beginning is 2,000, and then work in progress at the end is 1,200 negative. So the net would be 800. So COGM plus with work in progress, and then you have cost of production. 97,200. That's it. Next, income statement. In the income statement, you need sales, and then you need cost of sales. Inside cost of sales, there is opening inventory of finished goods, yeah, plus cost of productions, because usually you do purchases right after opening inventory, but since you are not purchasing it from supplier, you are a manufacturing business, so you produce the goods. So instead of using purchases in the COS, you use cost of production. And then minus with closing inventory of finished goods, and then you have gross profit, and then continue as usual, like usual income statement that we did. Okay. In the questions, we look at informations that we need to use inside the income statement. We have finished goods, we have office equipment, we have revenue, we have office salaries, we have selling and distribution costs, we have interest, we have finished goods, and then we have rent, but only 20%, and then we have a depreciations of office equipment. Depreciation. Okay. I need you to memorize all of these numbers that related to income statement, so that I do not have to back and forth the paper. Okay, you check your own paper, yeah. First of all, we did income statement. The first is revenue, and your revenue is 140,000, followed with cost of sales. Cost of sales is started with opening inventory of finished goods. Now your opening inventory of finished goods is 8,500. Please check the questions above. Yeah. After opening inventory of finished goods, remember you don't have purchases, but you have cost of production. Cost of production. Cost of productions is 97,200. It's from your answer in manufacturing account. This one. Okay. Next. After that, closing inventory of finished goods. Your closing inventory of finished goods is 9,000 given above in the questions. So your cost of sales now is 96,700. So, sorry, I'm going to move it here. 96,700. So you have gross profit. Your gross profit is 43,300. After gross profit, followed with other income, other revenue. And in other revenue, you have profit from disposal. Where is it? It's on the questions over here. This one. Profit of disposal. It goes to IS. Yeah? Next. Your profit on disposal stated at 600. So you add them. It's 43,900. This is total revenue. After total revenue, followed with operating expense. In the operating expense, remember, we have first of all office salaries, stated in the questions above, 15,150, and then after that you have selling and distribution. It's 9,100, and then you have rent. Rent is 20% times 18,000 equals to 3,600. And then you have office depreciation. Your office depreciation is, I forgot the rate. The rate is 25% per annum using reducing balance method. Reducing balance method, that means 25% times with cost is 3,000 minus with provision or accumulated depreciation, which is 1,000. So 2,000 times 25% is 500. Yeah, so that's it. That's your office equipment depreciation. And then after that, remember you have a loan interest. Yeah, it will goes to your income statement also. All right, office equipment depreciation is 500, and then interest on loan is 800. Done. You have total of 29,150 as your expenses. So your net profit would be 14,750. That's it. Done. Next question. State what is meant by the term work in progress. Work in progress is unit production that is half done. Productions half done means it has been started but it is not yet completed. Yeah, unit productions which have been started but it is not yet completed or not yet finished. That's the point. State two possible reasons why total direct cost. Direct cost means you have direct material as well as direct labor. Why does total direct cost in year 2015 were higher than previous year? This is just an example, yeah. 2015 apparently higher than previous year. There are so many reasons. First of all, maybe raw material price has raw material price has increased. It can. And then also maybe that's from a direct material point of view. In direct labor point of view, rates of direct labor has increased. It can also, yeah. Or maybe production level has increased. Production level increased because there are so many demand in the market, so we are trying to fulfill that demand, so the production level has increased. And all of them will increasing total direct cost in this year, in this 2015, yeah, that year. That's it. We're done. If there's any questions, you can ask me through email or leave comment. Thank you.